Daily Fiscal Pulse for the 13th of April, 2026. We're looking back one day, tracking how money moved through the system as of Monday's closing bell. Before we dig into the numbers, let's acknowledge what's capturing market attention right now. The Iran and Middle East situation is front and center. You're seeing headlines about renewed US-Iran peace negotiations coming from the White House, and that's clearly moving prices. Understanding that context helps frame what we're seeing in the fiscal data. The flow numbers show net transfers landing at $56.1 billion, which on the surface looks unremarkable. What actually matters more is the trajectory. Over the last 5 days, flows have compressed to roughly half their recent pace. Tax receipts are the main culprit here, delivering $71.3 billion of that total. Here's what's interesting on the price side. ES futures ended the day at 6,921, sitting comfortably above the 20-day moving average of 6,654. The 20-day range spans roughly 565 points. Despite the fiscal headwinds we're tracking, price is managing to hold its ground. Looking at this from a slightly wider lens, the slowdown becomes unmistakable. Government spending averaged $7.9 billion per day over the past 5 days. Stretch that out to 20 days, and you get $6.7 billion daily. That's a meaningful deceleration. Less cash flowing through the system means less liquidity reaching households and filtering into markets. The result is tightening financial conditions. Year over year, the story doesn't change much. We're $1,032.5 billion into the fiscal year on the spending side, which puts us about 23% ahead of last year's pace. That's substantial fiscal support, and it does carry weight for overall system liquidity. For those considering the long side, the fiscal picture deserves serious attention. Our conditions gauge is sitting at -62, which isn't exactly encouraging. But here's the historical reality. We've been in these waters many times, and the S&P has still managed to average around positive 0.9% returns over the following month, even with softer liquidity conditions. Markets don't track liquidity in a straight line. Leverage tells part of the story too. Leveraged funds keep adding long positions while margin debt is perched in the 96th percentile. That's high. Historically, extremes like this have functioned more as cautionary signals than bullish indicators. This is where the pieces fit together. Fiscal transfers are running below last year's baseline, which means the system's cushion is thinner. During supportive news cycles, we can still see markets drift higher, but when risk flares up, like a potential escalation in Iran or the Middle East, the downside moves faster because there's less liquidity sitting underneath to catch it. Also worth watching, we've now seen 3 straight days of declining fiscal transfers. That kind of deterioration typically shows up in markets with a short lag. 2 items warrant a heads up. The 15th of April brings the individual income tax deadline, which is historically the single largest cash drain day of the entire year and has the potential to shift near-term flow dynamics. Mark that down. Fiscal drag is definitely visible in what we're measuring, but the tightening pace may be starting to find equilibrium. How the scheduled flows land over the next few days will likely determine what comes next. That's the setup as of now.